The view from the other side. Guys, this is a Reddit post posted by Defago 2 days ago, and this is the view from the other side, and I found that this is worth more than making a video for. So this is probably going to be a long video. I'm literally going to read every piece of this, and in my opinion, it's a great representation of what hedge funds and market makers have done with the stock and what their plan is to do with AMC and GameStop and how the demand is being suppressed. So grab your snacks, get ready, and get up to 10 free stocks, each valued up to $2,500. That link is pinned in the top comments. Just download Moomoo and fund Moomoo to get that free money. I highly recommend doing so. Without further ado, let's get right into the video. Okay, so the whole aspect of this is imagining that we are a financial entity with these 5 things. Market making privileges in equity and large market share of order processing, meaning we could potentially internalize demand as liabilities, aka IOUs or failures to deliver, or let them pass through to the market. We also have access to all standard products, meaning we're only limited by having to find a counterpart to any financial instrument we might want to use, even bespoke instruments. We got a big balance sheet and a large contact network, including political enforcement and media, with also a widespread reputation of quote-unquote knowing what we're doing in a field which very few people know what they're actually doing. Okay, so for some reason or another, we decided to short a stock. We're fairly confident that it'll go bankrupt. Why we are so confident is irrelevant. We just are. However, we are not allowed, or it is suspicious, or just want to avoid the connection to have a position in securities we market make. Therefore, we use our network of institutions to have a series of hedge funds, not us, but bound to us through shared ownership or debt, aligned incentives, or whatever, hold the short positions for us. It's also possible that these hedge funds are taking this short position of their own volition, and we have nothing to do with it yet. The point is, the specific stock has a growing short interest. It's easy to find shares to borrow. All broker-held shares are kept within the DTCC books. That means they're all kept in a neat pile. We can borrow from the pile warehouse and throw a few pennies back as fees. We then sell these stocks to retail, so the stocks end up right back on the borrowable pile. They never leave the brokerage, and the brokerage stores them in the same pile. We are adding a liability, the short stock, and an asset, the cash, on our sheet. They're fungible, and it's all happening in aggregate and behind closed doors, so nobody has actual proof. Hell, nobody has reason to suspect in the first place, since the stock in question is a quote-unquote bad stock, according to the news, and the so-called collective meme says it should go down. Since each sold stock goes back to the pile, there's no shortage to the borrowable supply, and therefore no reason for the interest fee to go up. We can keep pointing at a share, using that share to create a liability, receive cash, and then point at the same share again. Also, if we occasionally often fail to deliver / borrow, who's gonna notice? Let alone stop us, right? Well, in essence, the customer bids / demands a share. The bid is routed to us by a broker. We grab the share from the borrowable pile, add this to the liabilities. We add this same share to the customer's assets. We also take the customer's cash from their assets and drop it in our assets. The customer's share is stored in the borrowable pile thanks to the broker, so the pile size has not changed. Result is demand is satisfied, the borrowable pile is unchanged, our liabilities grow, supply is not reduced, we took the customer's cash. Now we just need to be careful about the reporting methodology, make sure everything is tidy when the picture's taken, and as long as the pile is large enough relative to the daily volume, it's foolproof. Fantastic. Then each sale is free money and the sold stock goes right back for sale. Unnoticed, we're actually recycling the supply. The demand on the other side isn't. Buyers need actual cash to buy, and that shit runs out. With endless supply and limited demand, the price goes down. Price going down should increase demand, but as long as the price is expected to continue to go down, then that's neutered. People don't buy because the price is so low, but because they expect it to rise. Besides, more demand means more sales and more profit. Yes, eventually we're confident the company will go bankrupt, and then we'll just be left with 2 piles, one of cash and one of worthless liabilities valued at $0, pure profit. No need to even pay taxes since we didn't really close position. Then 2 things happen. First, some schmuck begins actually looking at the numbers, quote-unquote bad stock. Meme isn't enough for him, and he realizes that the stock is too cheap related to the fundamentals. He begins buying and spreading the word, which challenges our preferred memes. Suddenly, there's a narrative of counterculture resistance around buying the stock. It's seen as giving us the middle finger, and the kids think that's cool. Whatever, let's underestimate them. The second thing going to happen is that another guy, this one actually makes 3 commas. So he's a bit more difficult to deal with. He buys a bunch of stock and declares his intent to become an activist investor. He maneuvers intelligently, and before long, he's chairman of the board. While we're good at making memes for boomers, this dude is actually good at making internet native memes, and he, without ever actually interacting directly with the community, manages to cement himself as trustworthy, competent figure opposed to Wall Street and internet savvy. He outlines a turnaround plan which actually, independently of everything else, makes sense, and he brings the drive and level of compromise a founder figure can provide, as opposed to distant institutional investors. Now, a short position is a leveraged position, meaning we can be margin called if our unrealized losses exceed our collateral. Therefore, as the stock price stops going down and begins going up, we have to begin to actually monitor the stock price and the short position size versus the rest of our assets, and not all assets, but those considered high quality liquid assets and therefore valid collateral. The way this works is different asset types get assigned different weightings. The more liquid and risk-free the asset, the higher it counts. Cash is completely accounted at 100%, but a risky bond might be counted at 10% only. Some assets might not count at all. The difference between the average short sale price and the current market price multiplied by the short position size can't exceed our high-quality liquid assets, or we get margin called. So liability, current market price, position size, the value of the equities owed. Assets, average sold price, position size, the cash we got for the sales. Our collateral must be greater than the difference between these. Average sold price, current market price. Position size, value of HQLA. Suddenly demand, which has been growing steadily thus far, spikes. This has gone viral, and the transacted volume goes insane. Way beyond what we can handle. The daily demand is bigger than the pile, so we're forced to let some of it through. Our method has not been stress tested before, and thus we slipped. This means the price starts increasing, which fuels both more demand and FOMO and more supply from people who consider the stock overvalued and an easy short. The internal supply chain breaks. Suddenly, everyone's getting margin requirement notifications. The brokers necessarily don't know what's happening. All they know is that they sold a lot of stock, and before they can turn around and buy it from us, the price has doubled. Margin requirements go up, so seeing this, trading is stopped at the broker level. They literally can't afford to owe any more shares. The Apple Store is out of apples. Close only. We, however, can keep selling, and we do. No new long positions, only new short positions. The perfect price has to go down. Regardless of the demand, the price falls down. The news spin this as a squeeze that's now over. The price falls all the way down to $40, and then something breaks. Someone gets a margin requirement they can't meet, or someone places a buy order that's large enough, or something else happens and forced buying begins, which again spikes the price. Liquidations are carried out, and at some point these short positions end up in the market maker books. While a hedge fund can get killed from such spike, not us. We are a massive player, and we can sustain a lot more. We consolidate most of these short positions to avoid any further melt-ups and formulate an actual long-term strategy to get out of this mess. Melvin, Archegos, and others are now dead, and we hold their books within ours. Up to now, we've had to survive by using collateral against the short positions, which means that at a certain point, we need to liquidate non-qualifying assets and turn them into cash or some other acceptable form of collateral. Therefore, we need to sell our other positions and turn them into cash. This explains the stock's negative beta. When its price rises, we sell other stocks to raise cash, which lowers their prices. When crypto is no longer acceptable collateral, we sell it for cash, and the price dumps around June. So in essence, the stock price has an inverse correlation to the price of anything else in our books that's not collateral. However, this isn't the best way to handle this. This is affecting the rest of our business and won't work in a longer time frame. Since we're the market maker, we don't really need to do the whole song and dance around borrowing shares and holding collateral. We can just directly create them as liabilities. This is the famous failure to deliver, aka price suppression. They mark your assets and their liabilities, but that's it. Also, instead of being worried about collateral, we are now worried about solvency. We turn around to the security-based swaps / total return swaps. What are these? They're a piece of paper that's worth the difference between the values / returns of the two securities. I can then replace the shorts versus collateral method with swaps. No need to bother so much with high quality collateral, since whatever's on the other side of the swap essentially functions as collateral. I only need collateral for the difference. I can get a negative exposure on the stock price against a positive exposure on the overall market. This way, if both go up together, then it makes no difference to me. Likewise, if they both go down together, any decrease in value from the movement of one is offset by the movement of another. Let's assume our swap is done against a broad market basket and call it the counterweight, CW. Now, instead of the stock in the market having an inverse correlation, they now have a positive one. If the stock goes up 10%, then as long as the counterweight also goes up 10%, then the value of the swap hasn't changed. I don't have to massively sell everything. It's less suspicious. Reporting rules are way more relaxed. The enforcement agency is much more amenable to my proposals. This works both being long stock versus short market or long market versus short stock. Fine-tune my exposure both ways. Importantly, what before these counter-cyclical spikes are now pro-cyclical? Has the stock gone up? Nah. It's the whole market. Nothing suspicious. While before we counteracted the demand with short selling, now we just failed to deliver, essentially neutralizing demand. Sure, that's even more troublesome, but nobody's ever paid any mind to Dr. Chimebath before. Why would they start now? So if anyone buys the stock, we just add to our liabilities without it impacting the actual market, supply/demand. We can selectively decide to let some demand pass in case we need to raise the price. What this brings about then is a delicate balance. We can let demand for the stock reach the market, in which case the price increases. We can let demand for the stock go to our liabilities directly, in which case the price decreases. Then we can observe demand/supply and have an algorithm decide which percent of purchases to deliver, monitor social media bullish sentiment, sell them calls, and reduce delivery percent. Let the spot purchases go directly to the balance sheet. Price doesn't rise, bearish sentiment. Do the opposite. If the stock's demand goes up, we can decide whether to lower the delivery percent, through which we avoid a price increase, but in exchange become more levered. We want the price to be as high as possible up to the point in which we can get margin called to the ceiling. Therefore, we'll deliver as much as we can and start FTDing when the price gets too high. If the stock's demand goes down, we can decide to increase the delivery percent, through which we lower our leverage, but in exchange the price doesn't go down. We don't want low prices. More people will buy and we'll lower our average entry price. Therefore, we'll reduce leverage as much as we can. We might prefer to lower the price, but that depends on more manipulative strategies and not market-based ones. Therefore, we observe supply and demand and decide what percent to internalize and what percent to externalize, thereby controlling the price. Depending on how big of an institution we are, we might be able to do the same to a lesser extent to the counterweight itself. Say if we process 70% of all orders, who's to say we can't nudge the S&P a bit, eh? Even if we can't though, that's unimportant. If the counterweight's price goes up, that gives us more breathing range. We can tolerate a higher ceiling stock price without danger, so we'll internalize less, reducing leverage and increasing the price until we reach the new heightened ceiling. If the CW's price goes down, that gives us less range. We can tolerate a lower ceiling high stock price or risk a margin call, so we'll have to internalize more and become more levered, but lowering the stock price. Alternatively, we may choose to pump the counterweight. A couple million hitting the ask at the right moment should be enough. So this is pretty much saying that when the market drops, it's going to be worse for them. They can tolerate a lower ceiling, which is what we've been talking about on the channel. We have then two variables of import. The counterweight's price, over which we may or may not have a degree of influence. The stock's price, which results from demand, which we observe, and percent of FTDs, which we control. In this way, short selling is something we long stopped doing. Did the shorts close? Not really, but who cares? The question is whether we still have an exposure to the stock price, regardless of the mechanism. Up to now, we have a nice little model. It's not infallible. Our control over the variables might not be perfect, and if demand doesn't stop, we'll eventually be in trouble, but these dudes need to eat. Wait long enough, and they'll get discouraged. A split, you say? The size of my liabilities hasn't changed. Yeah, there are 4 times as many stocks, but I don't give a fuck about the stock number. I care about the notional size of the position. In the shape of a stock dividend, yeah, nope. Spread some confusion about it. What can they do? Yeah, they'll seethe, but they've already seethed all along. If someone in actual position of power comes around, we'll send some guys into suits to dazzle them up with words. Who will they believe, the suits or cherry-picked examples of particularly stupid apes? We like the chaos. The more tyranny is to find the truth, and the longer we can get away with this shit. Unless the company withdraws from our system, in which case I have no idea because the debate shifts over to the legal battleground instead. What else could they threaten us with? Well, you know what? DRS. On one hand, if 100% of these shares are accountable for outside our system, then we're suddenly on the defensive. And now they don't really have to care about what we say the price is, do they? They could separate completely, accounting for all the shares and trade within a separate system. What would we do with the deluge of DRS that'll hit? I have no idea, but it seems like the supply and demand equivalent of dividing by zero. On the other hand, every share removed is essentially forcefully accounted demand. Say you buy a share, I drop it on liabilities and fail to deliver, and then you DRS it, and then you're indirectly increasing leverage since total shares in books / actual shares in my vault, the ratio just got reduced by one of both the numerator and denominator. Do that enough times, and since the numerator is higher than the denominator, we gradually increase the ratio, which makes the effective demand on a price have a larger magnitude. How? Because the ratio is also the ratio in which I transform demand into either a price increase or leverage. When we turn demand into price increase or leverage, the rate at which that happens is that ratio. The more we DRS, the higher cost of turning demand into price or leverage. Meaning, the more we DRS, the more violent price changes will be, and the more magnified leverage assumed will be. DRS 100%, and that becomes divides by zero. Therefore, a separate market observer might want to consider two indicators as endgame conditions. One, the DRS percentage plus its rate of change, which can be proxied by the price of the stock against some measure of how much free cash retail has, because this determines the speed of DRS. The lower the price and the more available cash, the faster DRS will increase. The stock price, number two, the price of the stock. Against the counterweight, let's assume a broad market index of multiple asset classes. If the stock outspaces the market, then we know the swaps are closer breaking. This will have two possible effects. Every time except the last, it will cause the stock price to go down or the market prices to go up to keep the swaps alive. Eventually the swaps will die and the stock will go up and the counterweight go down in a self-reinforcing deleveraging. What happens then? I don't know. I wouldn't want to find out. I'd take more and more risky moves if at one point I'd have been careful about the legality of my moves. Then by the end, that wouldn't really matter much. Might even want to try to get a political power to leverage that. After a certain point, the capital market problem spills over into legal, social, mimetic, political. Whoever's managing this shit show hasn't slept in a while, and I can guarantee. Now, this is the end of the Reddit post, and my conclusion is that they know that we know what's happening, and I'm going to be DRSing my GameStop shares and putting up a video on how to DRS your shares before I DRS my AMC shares. Now, there's one problem with this, right? Most people already DRS in GameStop. This is the movement. It's at almost 56%. If we get that to 100% and it squeezes, boom, bada bang, bada boom, great. Except GameStop is at around $30 to $40 right now. It's at 25 something, and AMC is at $5. So AMC has a lot less time for us to figure stuff out. And that is exactly why I wanted to put this Reddit article out to you guys. Now, ultimately, these market makers are essentially just running positions through other funds. While each order that's pumped in and out of AMC is being routed from broker to the market maker, they essentially have a lot of control. And what they're doing here is pretty simple. They have a few separate pools, and your buy orders essentially are just being turned into their liability. They're using the overall stock market, we'll just use the S&P 500 for example, as a counterweight. Therefore, in theory, like we talked about, if the SPY ended up actually crashing, it pretty much just stated that it would put more pressure on them for collateral reasons. Now again, retail stopped buying the stock. They even said it here, we have to eat. If too many buy orders fill up their liabilities, they will let some go, and that is why you see mini rallies in AMC such as this and this, right? And then back when it ran to 70, everything was overfilled and they had to set it to position close only in a sense where market makers and hedge funds just got to short it with a 100% chance of them profiting. By being set to PCO, the stock had to go down. So essentially they have a pool of liabilities building up, and just like we've been talking about, they can crack at any moment. However, their plan is to get it to $0 and bankrupt the company. Therefore, they don't have to pay anything on taxes. They profited everything and the liabilities are gone. everybody who put money into this will have no money, and it will have meant nothing. Hopefully this helped you understand with everything that's going on, and let me know in the comments your conclusion if DRSing is the way to go, because right now I'm going to go look into it and give you my final answer either today or tomorrow, and I will let you guys know my plan is, and I will DRS my shares with you before I just do it by myself. Overall, guys, hit the like, make sure to share this with somebody, and drop a comment down below, because this Reddit article was by far the best thread I've ever read on Reddit. Love you all. Lottery Stocks out.